inside a bracket. The possible outcome considers a probability of each outcome. So this one actually shows the average value of all the data points in the data set. And X becomes a random variable we can treat as the data set. That's a more realistic case in the real world data. So expectation of X equals when you have a probability for each data point, right? You multiply with that probability, and then you aggregate all the possible cases. So this can be interpreted in a slightly different ways. So if you actually have a historical data, we know the data actually occurred. Those are actually already happened. So you had a probability is just equal case. But for the future case, when you don't know the exact probability, and then if there is a way to estimate the probability, and then that's not going to be always equal probability. And in mathematics or statistics classes, you've seen more like this type of integral. It's a mathematical expression with x times an f of x. The f of x is the same as probability, but when you have a probability expressed as a function, and then your variable x can take any value as a continuous variable. This needs to be expressed in this way with the integral, not the summation sign. So this is just the two different expressions for the expectation depending on the variables and types. In for finance case, you're going to see much more discrete case. But for understanding purpose, you also need to understand this integral, how we are actually calculate this one. Integral, you need to understand basic one, even though we're not going to practice that much here. One thing to emphasize here in expectation-wise, when there are two random variables, then the product of those two random variables, and x and y, and then if you calculate the expectation, then let's say that becomes the equal to expectation of x times the expectation of y. That is true only if the x and y are independent. So just for now, just look at this, and then we will see why this is true in the following tabs. Now in the variance calculation, the variance for the random variable x. So you all actually have seen some type of variance calculation. So variance is in concept is how much your data deviates from the average value. But how much is a measure of the deviation. So it's called dispersion, and the measurement of dispersion. So calculation itself here is in each data point, you subtract your mean value, which is an expectation of x, and that deviation you make a square value. The reason we make a squared value is the deviation can be negative value, right? The expectation can be greater than the extra data point. And then we want to measure that actual deviation in the same and positive scale. So we square that value and then aggregate all of them. And we're going to see in the following tabs, what is the issue of doing that. But first of all, you can see variables calculation shows squared deviation, which amplifies the deviations amount, right? So we have another measure called standard deviation. Sometimes it's expressed as S and then or sigma. So specifically, when we deal with the sample data set and then population data set, usually S is used for the the sample, and the sigma usually used for the population to express the standard deviation. So here, let's just say that S shows a standard deviation. So S of X is standard deviation, which is the square root value of the variance. Why do we do this? First of all, right? Take the squared value, aggregate all of them, and then take the squared root. So it looks like, we're going back to the original value. Yeah, it is right. And then also the reason why it's called the standard deviation, because we are standardizing the variance, the value. As I said, variance actually has a square in the calculation, so its measurement is large. Actually, it's the distance, all the distance from the data points from the mean value is squared. So how can we make that deviation back to the original scale? That's why we take the square root. We'll see the actual calculation and standard deviation in the following tabs. So this tab is just an introduction. So here, what I added on the right side is the variance calculation. So conceptually, right, I explained what the variance is, and then now using the expectation, the operator, right? So you may have seen this with the sigma. So it's the same thing. Expectation operator, you're supposed to calculate all the possible cases, because in this case, we're treating X as a random variable mathematically. And with the sigma sign here on the left side, we're treating this X as a data set. But the same thing. So on the right side, with the probability concept, if you calculate this one inside the large bracket first, let me use the pen. So you just expand this part. And it's not working at the moment. Yes. So if you just expand this, and then x squared minus 2x times e of x plus e of x squared. This squared is all outside here. Now, the property of expectation operator, this can be applied into each component when there's negative or minus or plus operator. So this can be proved actually mathematically, but for now you just think, okay, we can just take it as given possible. So all of them goes here. So separate expectation of x squared minus expectation applied it to x. So 2e of x. Applying expectation into the expectation, that doesn't really change the impact. So it just comes out as an expectation. So this one twice, right? 1, 2. And then the same thing. Expectation of x squared just comes like this. Now, we have two expectations here, so it's squared, and then one more. So the end result become negative expectation of x squared, this total value squared. So some of you may have memorized this one as a formula. Variance, your calculation wise this, but sometimes it's easier to calculate expectation of old squared value first, and then minus average value, the mean value squared. Excuse me. This, well, it's not really, it is useful formula to remember. Now you've seen it, how it's derived, so you can actually memorize if you want to. But it's pretty simple. And then why this is true. So there will be cases, and then we use this type of calculation instead of going back to the original calculation. You can do the either way to get to the variance. And one more property of the variance, and then is identity. Here, when you calculate the variance, and then there is an original random variable or data point. So let's say a certain value has been multiplied to the data points and then added, a certain value is added. So A here in front of X is magnifying or actually reducing your data in scale. So if you put A to 2, your data points become multiplied by 2 in every point, right? So it's magnified. But plus B is actually you're shifting your data points. So you can imagine all data points are shifted by B amount, whether it's positive or negative. That would not change the variance, because the variance is a deviation from the mean value, right? Because mean moved together with all the values. But the variance in the scale-wise, it changed. But how much? So I know some of you also memorized this one, and then I hope you understand why this is the case. And then A here, we can call this coefficient for this X. When it comes outside the variance, it comes as A squared. So what am I saying here? Let's say, for example, where is it? Yeah, example, the variance of 2x plus 1 will be 4 variance of x. So why this is true with a 4? You can actually actually show if you plug in this ax plus b into this place of x, and then you calculate all this, you follow the definition, and then you will see what actually the definition in this case, either way, you can follow this way, you expand it, and then you will see why a squared needs to come out. Yeah, it's pretty simple. So I want you to actually check on your own, right? It's pretty straightforward. If you just didn't know why this is true. Okay, so there's something to remember as a property of variance. Now, moving to the covariance in the second tab. The covariance, its name is similar to the variance, right? And so there are two variables involved in the covariance. So covariance is a measure of dependence on two variables dependence on each other. So there's always two variables, x and y. And this is how you can write down COV, code. And then the calculation is, if you in probability concept, right? Expectation, but this is product of the deviations, but it's pairwise product. So what I mean is, so x minus e of x, this is the x deviation from the mean value. But think about in the data perspective, if you have many data points, right, you're gonna have to calculate one by one. So, but you have a pair of the data set, x and y. So first, but you calculate x minus the average value of x. For that data point, you gotta multiply by the deviation of y at that data point, which is paired with x. So you have to calculate the product of the deviations, all of that one. That's what this expectation sign means. If you actually have the data points, right? So your probability is given to you as an equal. So ultimately, I will show you how you can calculate this. But for the so one more thing, and many times expectation of value can be written as mu, the Greek letter. This is common in populations case, because usually we in statistics, especially in a hypothesis testing case, we want to estimate the population's the mean value, average value, which usually not known. So we express that one as a mu. So we can use mu instead of expectation of x. And the subscript just shows what random variable we're dealing with. But this is just like for the sake of simplicity, you write less than expectation of x all the time. So now the calculation, right? Again, this is similar to the variance calculation I showed earlier. There's a different expression for the covariance. So yeah, covariance, again, by definition, don't try to memorize this one, just think about the definition of the covariance, what it is in words, right? A pairwise deviation, but this time there are two variables. You just expand all the components. There will be 4 elements in there: xy, x times e of y, e of x times y, ax, ey. So as I said, this expectation operator can be applied to each component. So this comes out xy and exey, exey, and then exey. So this exey actually cancels out. So what's left here is expectation of product of xy minus e of x times e of y. This is very similar to the variance case we saw here. Right? So this is just a different way of calculating covariance. When you have this type of data, right? The product. So oftentimes you actually have to calculate. So one way could be easier to get to the answer than the other. So we will see actual calculations in the following tabs. These are just definitions tab. So what I want to emphasize here is, if the random variable pair, right? It's important part is this is actually pair. X, Y can take on the values, certain values. So these are our data points with equal probabilities. So this is important part. What is the equal probabilities if the data, if you already have the data, right? That already happened in the past. So that means, the probability is just distributed by all the number of data points. If you have 10 data points, you can think as like each data point happened with a probability of 1/10. But you don't have to think about the probability much for the data already you have, because the calculation, right? If you calculate the product of deviations for each data point in each pair, at the end, you divide it by n, right? Some of you may have memorized this one as just formula and then just mechanically just use it. But think about this, why this n is used. Because in probability concept, right, with the expectation, you need to multiply by probability. But this probability doesn't play a role in the existing data points. So you're just dividing by 1 over, multiplying by 1 over n, which is dividing by n, that plays as a probability, which is equal probability. This will become more obvious when you see the actual data set. So here is a little hidden explanation here. The sign of the covariance shows the tendency in the linear relationship between the variables. What does that mean? So when you calculate the covariance, right, think about the definition again. Deviation of x times deviation of y. So it's always useful to think about certain data points in a way this is widely used in the regression, but let's say data point, and then this line is average line. There are a lot more data points, but this one shows average value. Oh, well, that's not actually true. Sorry. When if you want to show the average value in the data set, you should not show this type of the regression. This is the actual regression concept. Actually, the average value in the actual data set will be just a straight line. The distance here from the average value can be negative or positive. This is positive or negative, right? If you multiply positive and negative value, right, that the result will be negative. So that's what this sign means. Covariance sign can be positive when both deviations are positive or both negative, right? But one variable has a positive deviation, the other variable has negative deviation. And the result of the covariance for that pair calculation will show you the negative, right? So the sign of the covariance shows the tendency in the linear relationship between the variables. So positive means it's actually moving together, and then negative means moving the opposite direction. That's what that means. And also the magnitude of the covariance. So when you calculate it, you will get a certain value, right? Whether it's positive or negative, but the value itself is not easy to interpret. And again, we will see with the actual data set, what that means is let's say your data point is, a single digit number, right? Either want to go, let's say 0 to 10 or negative 10, but the variance or covariance values will come out with a, 2-digit value, or it could be larger. It could be 3-digit possibly. So let's say variance or covariance like a 50 or 60. What does that mean? So your data points had all like a 1, 2, 3, like these types of value. So the magnitude is not easy to interpret, and then that really depends on the magnitude of the variables. So we will see what we can do, because that when the standard deviation plays a role, because that's a standardized deviation amount. That's what's called a normalized version of the covariance. So correlation coefficient, we will see how we can actually calculate what its correlation coefficient means. If you just memorize, and then if you still remember the formula, but it's time to think about what actually that correlation coefficient means to us. Some properties, yeah. So you may be aware already. So in covariance calculation, I said two random variables, but if you put the same random variables, right, in the covariance calculation, that actually becomes the variance of X. That by definition is the same thing. You replace Y with X, right, everywhere. That's why this expression was similar to this, because that is true, right? And then we often write down variance instead of VAR, we can express as like sigma squared. More simplified form, just you write X, the variable, as a subscript, but this actually means the variance of the X. X is a random variable in this case. Another thing, in X and Y are independent random variable. So this is not an easy concept to understand in real life case. So you all heard independence, yeah, or independent, from your classes, right? And probability or mathematics. Okay, and there are all types of properties, what the independent means. What does actually the independence means in the real life? Those two data sets, right? They're not related. They do not affect each other. And if there's a way of finding the dependence, right, because there are a lot of variables are related, or there is dependence. So if they are independent, the covariance actually will be 0. This is the property. So, but the other way is not actually always true. So even though the covariance shows a 0, right, it does not mean independence. It's actually not correlated. So it's called uncorrelated. And then uncorrelated two random variables does not always guarantee the independence, right? This, for now, just you gotta just probably remember this one, because think about it, you can find the actual examples like that, right? But showing that one is it's gonna be it's gonna take a little more mathematical background. So we're moving on without going to the details about that. But just for now, remember, when two variables are independent from each other, the covariance will be 0. Now, look at some data sets. Again, top left corner here, there's a link to the video clips, which was summarized in the main Excel file, class 5 file, right? So if you're not familiar with the topics and to watch the video, this question here, my friend and I have bank accounts and we make and save about the same amount of money. and our banks are also similar to each other, so in about the same way. What this means here, right? In data set here, look at the two columns. My bank deposit, this is my deposit, and this is my friend's deposit. And my banks are similar means we use different banks, and then my bank has deposit amount, which is actually just scaled up from my deposit amount, so that it shows exactly the same behavior as mine, my deposit. And my friend's bank, which is different bank, is also scaled up from my friend's deposit, right? It doesn't have to be exactly the same, but it shows, right, a different amount, like multiplied by $1 million. So a lot more deposits in the bank, right? But in a very similar way, right? Now, let's calculate the covariance and then correlation. I will tell you how we can calculate the correlation, but how do we calculate the covariance? Or we can see the variance first. The variance is for the single variable, which in this case, either my deposit amount or my friend's deposit amount. Here, the variance, Excel has already built-in formula. var.p, here the p means we treat this data as the population. In statistics, so you gotta specify whether it's a population or sample, depending on your intention of using the data. So here, we don't have to differentiate that one. So we're just gonna treat them as a population because we're studying about only this data set. So that's why P. And then by the way, the calculations can be slightly different depending on the population or sample. This case, it gives us 464,000 as a variance for my deposit amount. And then my friend's deposit amount variation is 170. It's much less variable or volatile. And then in the bottom, I calculated the average amount of the deposit. It'll be useful in our calculation if you want to go to the step-by-step calculation instead of using Excel formula. So in order to calculate covariance, there is a function in Excel as well, the covariance.p, again, treating this data set as population. That's our decision, right? Excel just does calculation, and we just selected two data sets. It will give us a covariance amount, 125,000. But what does actually this 125,000 mean to you? So you can't really tell much based on this value. So let's go through the step-by-step calculation to calculate the covariance. We're going to call it this data set as y. It's like a random variable y. And then this one x, y and x. So, and calculate the deviation. So on the right side, I calculate deviation for each data point, deviation from the mean value, right? Mean value is calculated in the bottom. So y minus y bar is how we express. Remember here in this type of expression, x and y in the subscript means each data point you subtract mean value. At the end, we're going to divide it by number of data points. So you calculate deviation first. But this, again, this is a pairwise calculation. So you calculate deviation in x as well. For all these data points, how many data points do we have? 10. So we calculate deviation for each data point. And the next step is calculating product of those deviations, pairwise again. So the deviations, multiplied here, row in each row. For all 10 data points. So now, what was the step in the covariance? You got to aggregate all of that product of deviation, right? So if you add all of them, it's 1.2 million. Now, divided by number of data points, 10. Okay, this is 125,000 is the covariance, which matches to the number with Excel's built-in formula, right? So now you know Excel's built-in formula does these calculations for you and it give you covariance. But now you also know how to calculate step by step. One example here, another one, the variance, right? What we calculated, variance is squared deviation, right? So this one we called it X now. So deviation squared for X, you aggregate all of them. So 1.7 million, and then divided by 10 gives us variance for this data set. So instead of using just 10, I used the count function to count number of data points. Imagine you have a really large data set, or you don't want to count by reading it, just using the function to calculate the number of data points. So now, if you use the same covariance function, we can also calculate covariance between my bank's deposit and my friend's bank's deposit. And then it gives us 125, what is this? It's a very large number. It's a trillion, million, billion, trillion. It's a quadrillion, I think. It's a very, very large number. So between these numbers, 125,000 and then quadrillion, the covariance, it's really hard to say. I mean, this is a positive, right? Covariance is a positive, which means they're moving to the same direction. Whatever we're looking at, this when I say they, my bank deposit and my friend's deposit, or my bank and my friend's bank, those two, both, relationship shows positive, but covariance scale wise, we cannot tell much. What does this measure tell us? This scale is so large. That means covariance, they're depending on each other really a lot. No, that's not it. So that's what I explained earlier, the difficulty of interpreting the meaning of this measure. So that's why we use correlation coefficient, which is a standardized value. Excel has function of correlation. I'm going to jump into the correlation definition tab for short. Here, you have a covariance here. Correlation is you divide the covariance value by sigma of X or sigma of Y. So the sigma here is standard deviation of each random variable. What does it do? If this is a variance, right, and then this will be a variance too, if the same variable, right, it will give us just the one value. So dividing this covariance by standard deviation of each variable scales down back to the original variable. But this time it gives us percentage, because standard deviation wise, how much this covariance shows will be always between -1 and 1. That's why we're actually expressing this one as a percentage, but you can say this is just 0.45, right? If it's confusing, why is the percentage showed up, right? From the dollar. Because this dollar also does not really mean much. I wouldn't actually put this dollar sign here, but this value came from dollar, right? So covariance is 125, but correlation is 0.45. So 0.45 is, okay, it is related. They're moving to the same direction because it's positive. Now, 0.45, you can compare between the two data sets. 0.45 for these two data sets and this 0.45 for the other two data sets. Okay, the relationship between the data sets here, between these two data sets, if you think about it, there are two different cases. They have the same relationship by the correlation. Of course, by design, they have the same relationship because we built it like that, right? By multiplying millions to each deposit, me and mine and my friends. But by correlation coefficient, we can tell the relationship, not by the covariance amount. So we'll talk about this a little more when we get to the correlation part. But now we've seen the actual calculation, right? So I want you to understand both ways using Excel's built-in function and this step-by-step calculation following the definition. If you recall this definition, right? This type of definition using the data points, and then actually variance calculation will be the same. Okay, now, all right, variance of sum. So technically, this is a variance of sums of independent random variables. So what does this mean? Sum of, okay, let me draw here. That capital X is the sum of all the X values. So this X is a random variable. So there we have n random variables here. And then sum of all of that is called X. Now we calculate the variance of that X. The result is variance. You calculate the variance of each random variable and then aggregate all of this. This is true. What looks like this is obvious, but that's not. What we did here is put the variance for entire thing, right? Not inside here. What we're saying is the variance of X and then add all of them. Why is this true? Let's say you are summing multiple independent observations of variance. So important condition here is independence, independent random variables. When you sum n of them, the variance of the sum is n times variance of X. So in this case, variance of X here, this is maybe a little confusing. This is a variance which is equal to all the random variables, let's say. Let's say variance value is the same for all the random variables. And then if there are n random variables there, the variance is just n times of the variance of any random variable. This may not be the really clear expression. Well, let's let me move on, and I can show you on the right side what I mean, actually using the different random variable notation, because X here with the subscript, that makes it complicated, because if you're not really familiar with mathematical expressions, right? It's always confusing if you have like a subscript and the superscript with this all the Greek letters, right? It's not really clear. So until you see. So on the right side here, I'm showing variance of X plus Y. So instead of writing down sigma then xi, right? This is, if it, let's say it's 1 to 2, what is this? X1, X2. Remember, this X1 is a random variable, not just one data point, right? That's a lot of people are confused, right? When you see the subscript, sometimes it was a specific data point. There is a reason, or sometimes why it's used X1, small x1. This usually means one data point, possibly inside of this random variable. And then if you use the Y subscript like this, that means it's component in the random variable like this, Y. So here, instead of using this subscript, we're using just X and Y. This is simple. X and Y, both random variable, but independent of each other. Now, this is what we're doing exactly here, the same. We define certain random variable, and then sum of them, and what is the variance of this one, whatever we call it, is X and Y, right? We can say, okay, we are calculating variance of like Z, when Z is X plus Y. It's the same thing. So now, following the definition of variance, for the sake of simple calculation, we're going to use this expression. So now X plus Y squared, an expectation, minus entire expectation squared. Now expand all of this. X squared and plus 2xy and y squared, right? And expectation still out there. And then this one, yeah, let's expand it in the next line at the same time. Putting expectation sign inside, operator inside, and then I lost my, so yeah, here, 1, 2, 3 from here. Now we expand it, squared 2 exy ey squared. Now, all right, let's see if anything can be canceled out. Okay, ex squared minus ex squared here. This cancels out. This cancels out. No, I canceled out wrong ones. My bad. Look at this. This whole thing, it squares outside. Careful. This and this is different from this. So this one stays. This one stays. Also, this one stays, and this one stays. Well, only thing, these two cancel out. Do you know why this one cancels out? This case, you remember, when two random variables are independent of each other, product of expectation becomes this. If independent. And all right. It's terrible writing here, writing pad, but That's why this one is the same as this, and with the negative sign, it cancels out. So only these 4 components left. But look at this. These 2 becomes variance of x. These 2 is variance of y. So interesting, right? It looks like almost you can just separate it, the sum of the variance as if, variance. This is not usually true. The independence of 2 random variable played a role and then gave us this outcome. So plug in, instead of y, the x. So what is this? Variance of x plus x becomes 2 times variance of x, right? So there was a 2x inside. 2 actually comes outside the variance, right? This is true because the independence of the random variable. And then this will be true for many random variables, not just the 2 cases. If we expand it to like a 10, does not matter. Someone is asking the question, if independent, yeah, it does not matter if it's independent or not. This operator always works. Expectation for the plus or minus operator, this product x and y, when it's multiplied, that you cannot usually just, this is not always true. It's true only when it's independent, but the plus and minus, independence does not have to be assumed. So this is what this sum, the variance of sums of independent random variable means. N times just single variance, right? Based on this expression, it may not be so clear, but I showed you with the example of 2 random variables. Now we have a random variable, the variance, the standard deviation of the sum. What is the sum here? Sum is sum of random variables. Then you take the square root of a whole thing. That's why square root of n comes out. And then square root of a variance is a sigma, right? So there will be questions about this one in if you're taking a class, a quiz or the homework. I see another chat window. Okay, so variance. No. Here, when I say variance of, right, in this example here, where did I show you? Oh yeah, here. Yeah, so I was not mathematically thorough. So in this case, x, capital X here is a random variable. And then a and b in small letters are scalar value. So what it changes here is an x. Even though we can plug a whatever value in a and b, you cannot plug b in x, another random variable, in place of b, right? If you type, I lost the pen again. Yeah, it's totally understandable if you have not taken any probability class. X plus X. These 2 are very different things. Here, V is scalar. If you don't know what the scalar, right? This is like a real value, not the random variable. Random variable can take many different values B, even though we represent at a certain value, it can be just certain real value, one at a time. But X actually represent multiple values in this case. You cannot put X instead of B and think about the same thing. Of course, this is the same, right? Variance of 2X. This one should become 4 variance of X. Because this is 2X and then this twice of this random variable. This B, it can be a certain value, 2, for example. And then variance will not have any impact. Like this. So you're talking about the two separate things. Yes, variance X and 2X the same, but we're not talking about the variance. We're talking about the expectation, right? Expectation of X plus X is 2 times expectation of X. This is true. But look at this expectation and variance. They are different things. Expectation is an operator. Variance is actually it's a calculation. Well, you can say this is the average calculation. This is not the average calculation. Variance has a different formula for that. So continuing this variance of the sum, right? This is what we did. Variance of entire sum of these random variables. Technically, this one, right? This is a result. Sum of variables, right? If this is a fixed variable, you got to aggregate all of them. This one will be expressed n times variance of X, which is this if the variance of the same, always the same for any variables. But there is another term with covariance of all the pairwise, right? This basically this is the same, just covariance of every pair, but when the variables are the same, x1, and x1 together, we call it variance. But x1 and x2, they're different, like x and y. Here, x1 and x2. Those covariance terms need to be expressed in general. But why does it not show up in our expression? Because we assumed independence. Remember, independent case covariance is 0. So that's why this old term actually goes out. This becomes all 0. Because of independence. This is independence. Very independent. Like that. Okay. So my recommendation, if some of you are not familiar with this basic probability, right? Or if you have not taken a probability class, this seminar's contents may not give you enough practice to understand all the details and the nuances in the probability. So you need actually more. It's always difficult to let the students how much knowledge you're needed, because I don't want to overwhelm the students, but actually a lot of knowledge, the background knowledge is needed to understand many things in this intro to quantitative risk management, because it's misleading. The name of the topic or seminar in the class says introduction, but this is introduction in graduate level, and this is an introduction to risk management, especially quantitative risk management. This is not, unfortunately, this is not the intro to probability 101 in college, or this is not the intro to the statistics. Yeah, so to make some of you to reality about this or the expectation in this IQRM, especially in the class, if you are taking classes. And like, right, this expectation is quite high. So some of you may feel uncomfortable when you're not familiar with these mathematical expressions and then statistics and probabilities. So that's why I said at the beginning of the seminar, right? If you don't understand something, if you don't follow, you got to make a mark and make a note, and then you got to dig deeper in the after seminar and then after the class, so that you can understand. Because sometimes, you know, you don't understand certain things because you simply did not understand the basic concept, or something was not clear to you, right? But you know, sometimes it's clear to others, right? So that's why this quantitative class is challenging. Just my little advice. Moving to the correlation, definition, and the calculation at the same time. I already explained this concept briefly earlier. The standard deviation was the standardized measure of one variable. And correlation coefficient is a standardized measure for the pairwise variables. When there are two variables, x and y, correlation is expressed as covariance first, but divided by, losing the pen, sigma x times sigma y. So this is a standard deviation of each random variable or each data set. By doing that, we are making this whole covariance into a very small value between -1 and +1. So there's benefits of doing that. And so first of all, right, the sign of the covariance is preserved. As I said earlier, the positive covariance means positive relationship moving to the same direction. A negative sign means moving to the opposite direction. This is true in the correlation. But in addition to that, and then correlation number actually can tell you how much those two variables are related, or two data sets are related. So let's see actual calculation of correlation coefficient and then try to interpret the number here in the data set. The same data set, my bank deposit and my friend's bank deposit, right? We went through this type of calculation already. So what's important here is you got to understand this is a pairwise calculation. So each time, this one does not show time of the deposit, but I can put the time here. For example, let's put this as a 2023 January and February. Well, January, February, like this way. If you put it, this is the same time, so you got to calculate the deviation and calculate the pairwise data set. So y minus y bar represents the average value or mean value of that data set of y, right? So this one for all 10 of them. Deviation of x, again, x minus x bar. Remember, we defined this as y, and this is x. So now when you have the deviations, you get the product of deviations, all of them, 10 pairs. And we did this already. Oh, sorry. It's frozen. Yeah. So we calculated this product of deviations, and sum of them and divided by 10 gave us covariance, right? This was the way we already saw here. Here, calculation on the right side here. I showed you this is exactly the same calculation here. Now, we need standard deviation of each variable. So how do we calculate that? Square the deviation, y and x separately, right? Sum of all the squared deviations divided by here. It's a little tricky. We can use 9 or 10. Here, if you treat this one as a sample, you have to use 9. Actually, if it's a population, you should have 10. As you can use 10 to be consistent. So this is a variance of y, and this is a variance of x. What is the standard deviation then? Square root of this number. Square root of this number. So these two are standard deviations. So correlation coefficients is covariance divided by product of each standard deviation. Gives us 0.45. If you recall, right, that was the number in our calculation. We already saw that, but 0.45 here. But I'm going to show you again, once again here, using correlation function, correl, and now we have to choose two data array, comma, calculate. This one, 0.45. See, using the Excel built-in Excel function, or we go the long route to calculate this everything and get the number. This is a correlation coefficient. 0.45. This, so okay, still we can't really tell a lot about this number. 0.45. When it gets to really close to 1, or let's say it's a 1, which can be said perfectly correlated, perfectly positively correlated, means two variables, x and y, move to the same direction perfectly all the time. That's what positive 1 means. Negative 1 means they're moving the opposite direction. It's complete opposite. 0 means it's not correlated. So it doesn't matter. It's not like when it goes, one variable goes to moves up, right, value-wise. The other variable can go up or down. It's not consistent. There's no real correlation. So that's what the 0 means. So let's look at this exercise, what these values can tell us, or these values can change. They create two vectors of random numbers and calculate their covariance and correlation. Create two new vectors. So there are values generated between 10 and 100 using the random function. We're going to fix this. Otherwise, it's going to keep changing the values. Now, copy this value and paste it here using the covariance function. You calculate the covariance on up top and correlation here. The covariance is 228 and correlation is 0.43. Okay. And the bottom, this is average value, right? 49.5. Now, copy this data set, paste it. Now we're going to sort it using the function data, sort. Sort column by column. Okay, so now is data are in ascending order from smallest to largest number, right, in both column. Now look at the value. The average value for the first data is the same. But correlation, covariance and correlation is changed. Covariance became 499, much higher, and correlation is almost 1. So why average is the same, but correlation and covariance changed, or they're very different from the original data set? Yes, some of you already have the answer, because this is a pairwise calculation. If you change the pair by changing the order of the data point in the data set, the covariance correlation will change. This is the same exercise, changing the order of the data set and then calculate the value. You see how you change the data, how to sort the data, the correlation can be completely opposite. Showed already this one in the previous steps. I'm not going to go there. Actually, back to the original class 5 file. Now the multiple histogram demo. Now we have data set here. It's actually created from the data table. That's why, but it's actually data set is a fixed. It's a 1,000 data points. How do we create distribution from the data? So first of all, distribution line, which you usually see like a bell curve or any types of distribution with a smooth curve or line, you cannot do that from the discrete data points. But so first you create the histogram and you connect at the top point of the histogram, the bar, and then shows a line. So the result here on the right side is this connection of the top point is a frequency bar, but show as a line chart. So I want you to practice this one after the seminar or class, how to create the histogram. So you got to count the values here and then create the bins. In order to generate the histogram, you need the bins for the data scale and then count the frequency of each bin. The technique will create the bin, right? You find the negative at the minimum and maximum values from the data set. This is data set we gave a name called the sims. This is generated for the simulation that follows standard normal distribution. The range is maximum minus minimum. So we want to create the bin from negative 3.5 to all the way to 2.7, right? How we can create is we decided to create 20 bins. You can create like 30 bins or 10 bins, whatever you want. But the technique to create the bins here, you split 1 into 20 buckets. So now 0 and 0.05, the incremental value is 0.05. And then you add that incremental value from negative and multiply it by the range. So you're dividing actually the range into small portions so that you can have the same distance, same range in each bin. This is just technique. If it's not clear, you got to think about it for some time. How this thing happens? How do you break this range into the equal distance but 20 bins? This is just a little technique. But after you create this bin size and 20 bins, you count it using the frequency function for all of this. This is created as a data array using the frequency, counting frequency per this bin. The frequency function actually count for the values from this to next one. Remember, I'm talking about the bin, not the specific data point. Not at this point, it's just a bin, and then we count. This is something you need to actually think about it if you're not familiar with this, but how to create a histogram in Excel. This is a good technique other than using the histogram function, which is not perfect actually. So now if you draw this graph from this data set, initially this came from histogram like this, right? This is not great if you choose histogram. Column or a bar chart like this. It was actually from the bar chart. But connecting this top line, back. Yeah. This line connecting the top of the bar chart shows the distribution. This is getting close to normal distribution. This is exercise coming from the generating, sample mean of different sample sizes using the data table. So you had this work before. So this was the data table exercise. But as you have larger sample size, it gets closer to the shape of normal distribution. This is the result of the central limit theorem. That was our result. One last thing to mention in this seminar today is log normal distribution. And there's a variable. When we say log normal random variable, it's just a variable that follows log normal distribution. So what is a log normal distribution? When we say log normal random variable, is if you take log value of that one, the logged value will follow normal distribution. And if you recall what the log function is the inverse function of the exponential function. So if you take log of the exponential of x, it becomes x, right? So that's a log function, what it does. So now, if x is normally distributed, look at this data set. Using the norm.inverse function, there's a random value inside, and with a mean and 0 and 1, it gives values. These followed normal distribution because it came from inverse normal function. Let's say this y, the next value, is exponential with the power of this x. So I expressed in this one e to the x. These are called log normally distributed, or this variable follows log normal distribution, or this is a log normal random variable. Why? Why here? Why? Now, I'm not asking you why, but this is why random variable. If this y random variable is log normally distributed, then x here, which is log value of this y, follows normal distribution. Or you can say x has a normal distribution. In other words, right, or equivalently, if x follows a normal distribution, then the exponential function of x has a log normal distribution. It's the same thing, actually, what I just said, in many different ways, are telling the same thing to you. But many students are always confused about this one. What is actually log normal distribution, right? So what variables are we talking about log normally distributed? In this example, if you remember this example, right, we're talking about y. This variable is log normally distributed. X is normally distributed. And you see the relationship between X and Y here, right? So that is simple, but when you actually see the questions about this one, you may be confused. So make yourself understood about this and practice histogram. If you haven't done it in the prior homework, this time it's not about the data table, but focus on how to create the histogram. So that is all for today. Are there any questions from today's contents? If not, next week, a different instructor will continue the seminar for the rest of the semester. So continue to attend the seminar. And then, if you find some certain topics you don't understand well, and then from the seminar or class, then I strongly recommend you to go back actually to find those relevant chapters in more basic statistics and probability and calculus textbooks and read and then practice examples, even though it will take long for you, but it'll be worth it. All right, thank you all for attending today's seminar, and I hope to see you in the future again. Thank you. Welcome everyone. This is Introduction to Finance seminar. So people are joining. If this is your first time joining this seminar, my name is Justin So. I'm one of the instructors in Enterprise Risk Management program at Columbia. So this seminar goes in parallel with the class with the same title, Intro to Finance, which is an elective course for the Enterprise Risk Management program students. Today's topic is primary equity market. So I'm going to share my slide on the chat window and then share my screen. For this class, you don't have to open this file now because looking at my shared screen would be just enough. Okay. So if anybody doesn't see my screen, just let me know. So what is primary equity markets? So in financial markets, largely if we break down into the equity markets and then the debt markets, and there are two separate types of markets. So I just shared a file. So a primary market is the issuance market, and the secondary market is for trading. So if you own brokerage account, then if you own any stocks or bonds or any different types of securities, and you already know how to actually buy and sell through your brokerage account, those are for the secondary market. People are buying and selling the securities that are already issued and traded in the market. The primary market is the companies issue securities. Is for today, equity market is for stocks. But we're going to talk about why do companies issue stocks, and then it's part of the raising capital. So all the companies in many different times in their life and they need capital, whether they're starting the company or they're already established company, but they need more capital injection to do expand their business or acquire other companies for many reasons. In various times of the company's life, and then the company needs to raise a capital, but by either borrowing the money or selling a portion of the company. So borrowing money is, even though you can think of the equity financing as part of a borrowing money, but you're giving actually ownership to the equity holders. Versus a debt financing, if you just issue debts, right? A debt is just purely borrowing the money because the debt holders do not own the part of the company. So how a company raises a capital really depends on the way the companies raise capital depends on the size of the company and its life cycle and stage, what stage in this company is in, and also its growth prospects. Oftentimes we think about only large, well-known companies, but you all got to think about smaller companies or startups and how they raise the capital as well. So we will examine some of the methods that the companies raise capital, and by looking at the early stages of the company's lives, and then the importance of the venture capital for such funds. And there are going to be a lot of terms used and procedures in this topic rather than any calculations. And then we will look at the process of going public. And then when the company starts, it's usually not public. It's private. Certain owners, have shares of the company, but it can be a public, meaning the stocks that represent the company's ownership can be traded in the public markets and exchanges. And then investment banks are involved in this process. So we will talk about that and then throughout today's the slides. But fair warning to today's seminar is we're not going to have much of a calculation or math in today's seminar. It's a lot of talking, a lot of words on the slides. It could be a little boring if you're not really involved in this process or haven't experienced this one. There are quantitative parts of raising capital. If you work in an investment bank as an analyst or a banker, there are a lot of due diligence you got to do and quantitatively building, spreadsheets and models. But important thing here is you got to understand the processes and regulations, what's the mechanism in the market to raise a capital ultimately. Even though those quantitative analysis back up your decisions, but we're going to focus on the terms in the primary equity markets and then processes today. And then in other topics, right, the valuations or the financial modelings and corporate finance, discounted cash flow techniques, all those things are used in these processes by private equity or venture capital and investment banks, but those topics will be covered in other times. So first of all, what is a venture capital? You may have heard of the venture capital a lot. So venture capital is it's companies or a group of people that finance is usually for the new or high risk. Many times new business have high risk ventures. The ventures like the companies and then with great ideas of business. There are also terms called angels or angel investors. Usually the angels are individuals who invest their own money. So rich individuals, or they may own certain companies, but they invest their money, but not in a large scale. So it tends to be focusing on the smaller companies or new companies and smaller deals. The venture capital firms, by the way, the venture capitals and then angels, there's no like a specific definition or clear distinction between them. So it depends on the size or situations. You may see these terms used in many different places. The venture capital firms, they specialize in pooling funds from various sources and investing them. So you can imagine, like if you see like a very rich person and invest their money into a certain company, you could say this is an angel investor. Or the companies that is like many times sometimes called the venture capital partners, or some capital partners that invest from the pool of funds, because they have their own investors for the company to do investment on new or startup companies. Those are the venture capital firms. So for the venture capital firms, the sources of funds are of course, individuals, the wealthy individuals, but pension funds or insurance companies, even the large corporations, university endowments. University has, usually many universities have like the endowments funds, or the organization that manages the university's funds. So they have a lot of cash, and then so they actually invest in the capital, venture capital. Like venture capital firm invest those pool of money into other companies. Then the venture capital firms invest in like usually 50% or less of the equity of the companies. And that's, that's a difference actually from the private equity, which we're going to talk about. So you may have heard the term private equity. So private equity firms has the investors with the capital from pension funds and insurance companies and high net worth individuals, which is the same as venture capital firms. But the private equity it has a slightly different structures from the venture capital. Also, their goal is different too. And private equity has the limited partners, LP, and general partner, GP, depending on the involvement in the investment. And private equity firms mostly buy mature private companies. So, and the streamline operations to increase revenues. What this means is, imagine you are starting company, small. It can't be that big. I mean, from the beginning, startups with ideas, and then you want the money to start your business. Private equity will not, fund your business, and then you need an angel investor, and from your family and friends who believes in you and then gives money, and or you found the wealthy sponsor believes in your business and you, and then you start your business. You grow your business, and then after some time you're becoming mature, you generated revenue, and then your operations more becoming stable. However, there are inefficiency in the company, and there are ways to make your company more efficient and then generate more revenue. And the private equities are looking for the opportunities like that. And then small companies, and then if the private equity see the opportunity to streamline the operation, let's say your company grew, now you have like 10 to 20 employees, and or your business partners, but it's not perfect, even though you are generating revenue. So private equity usually find those companies and purchase the entire company, 100% ownership. Many times they put their private equity people on the board of the companies, unless they replace the management, and then it actually steer the company's operation and drive it to whatever direction they want to go. And then if they streamline the operations, and then company will be valued much higher, and they can sell it later. So that's what private equity does. So about venture capital a little more. And to limit their risk, the venture capitalists generally provide financing in stages. So this is the common, if you have ever invested in the venture capital, or if you ever founded your business and then went for the funding, you will understand. But you may have heard of these terms, seed money, or the angel money. That's the very beginning of the company's in the life cycle. So there something called the seed round or angel round is when you need the initial investment. From the perspective of the venture capital, that's the very beginning of the company they are going to invest. So just look at the chart below, and the curve and the straight line here is showing the timeline in the company's life cycle from the beginning. When you have an idea and then you start your company, right? You're spending a lot of money, right? You establish your business, office, hiring staffs, a lot of expenses. So your cash flow is actually going to negative. And that's the time you actually need an angel investor. The seed money comes in. So that's still early stage. And then there's a development period that, you're starting to, making positive cash flow. And then this is all still early stage. So in the venture capital comes in this stage, and then they put their money, and then there's a round called the Series A or Series B funding. This funding, if you think about how do you get the money, if you are the owner of the business, you should go out and then search for the investors, right? And even though the venture capital firms are looking for the opportunities, right? You gotta find each other at some point. And then this is early stage. So Series A and Series B rounds are early stage funding. And then as the company grows more, and then later stage, and then growing still not as fast as before, but your business is maturing, but still growing. That's called a late stage. So you still need a fund, and Series C and D and so on. And then when the company matures, and then you don't see that, the speed of revenue generation as you saw in all your stage, venture capital firms exit. So they should have an exit strategy as well. The term growth equity has become more common as the form of venture capital in the later stage of the company's growth. And venture capital is used to invest in the mostly in early stage of the companies and startups, and then but they are also started more and more investing in the later stage of the companies after the company's business expanded, and then it's called the growth equity. So it's just a term used. And some realities. So the access to venture capital is very limited. So it's important to imagine, actually, right? Even though you don't have an experience, how can you actually find a venture capital firm, make them to invest in your startup if you are starting a startup? Or if you already have the angel investors, so your business has been started, but you need more capital. So National Venture Capital Association and NVCA actually estimated that the only 1 out of 100 is funded. So there are proposals, as a business proposals, and then you write down, this is your business, purpose, operations, and then proposals to generate revenue, and then in timeline. And then venture capital companies actually review those proposals. And then when they find something attractive, and then with good proposals, and they invest in. But this chance is like 1 out of 100. There's so many startups out there, but not most of them don't get funding from venture capital. So in reality is the personal contacts in the venture capital markets are important in gaining access to this VC. It's called the VC many times, VC market. If you see, I don't know, I mentioned about this Shark Tank from the CNBC. Shark Tank is a program that actually fund many startups, and in the TV there are the angel investors. Some of them are actually venture capitalists. They don't differentiate exactly, but some of them actually have the firms that invest. Most of the companies that present in the Shark Tank are the startups. Even though there are certain companies that are already doing well and then, establish the business, but they want to expand or they want to sell their company. Sometimes the 100% company is sold in the show. But how do you find this context? And many similar to angel investors, venture capitalists also find opportunity through connections and then get the request from the connections, personal connections. So that's just a reality. So it's not about just like a business idea is solid or great, and then you need the right connection to get the funding. And also venture capital is extremely expensive. What does that mean, expensive? Typically the venture capitalist will demand 40% or more of the equity in the company. I mentioned earlier, right? Private equity just acquired the company 100%, but venture capital invest up to 50%, but still demands 40% of the equity. What expensive means here is, you as a business owner or the owner, majority shareholder, you actually have to give up that much of the equity to the venture capitalist to get the funding. If you imagine this, if you're just like outside a company, this may not be a big deal, but the giving up the equity is a big deal, because you claim, it's your company, but someone else owns like a lot of part of your company, and which was not involved in the founding the company or going through the hard times, but they want equity. So the venture capital is expensive, and the venture capitalists frequently hold voting preferred stock and typically demand several seats on the company's board of directors, possibly appointing one or more members of senior management, which is similar to the private equity, but they hold a voting preferred stock. So if you have learned about the stock types of stock, typically preferred stock does not have a voting rights. It's common stock has, but there are preferred stock with the voting rights attached to it, and then that's what the venture capitalist usually wants to get, and then so that they have like a dividend in case, but also they have a right to vote and then to change the company's decisions, and then they have insiders in the board of directors seats. Venture capitalists tends to be specialized, investing in particular industries. So again, the Shark Tank is an example. Again, some of them are just the angel investors, but some of them are venture capitalists focusing on the certain industry segments. So certain venture capital firms they understand tech companies well, or fashion industry. And then they because of their specialty and understanding, and then they tends to invest in certain part of the industries. The venture capital funds operate much like a mutual fund, so raising investment pools and making investment for investors. So that's what I said earlier. There are investors for venture capital firms who gives them money, but the venture capital firms invest those money into other companies for the investors to generate return. So this mechanism is very similar to the mutual fund, even though it has a much higher risk. Another topic of raising capital is crowdfunding. So this became very popular for the last 10 years. Well, it probably did not exist properly before 2012. The crowdfunding is the practice of raising small amount of capital from a large number of people. It's usually through the internet. So you may have heard the name called a Kickstarter or an Indiegogo. These are platforms, and then this crowdfunding platform. So let's say you have an idea of a business or a product, but you don't have any money. And then you don't even know anybody who has money. So you just put this idea on the internet. And you tell many people, okay, I need this amount of money to start my business or make this product. You may have a prototype or business plan, but basically asking people on the internet give a small amount of money so that you can start your business, and then you promise them you're going to return the profits. So many people on the internet, they can use a very small amount, just, and then it will reach certain amount set. That's a crowdfunding. It became available in 2012 because of the Jobs Act. That actually allowed the companies to raise money like that through the internet and basically crowdfunding. And then they're selling equities in that way. So it actually provide a channel for the people who can actually establish business, right? It's part of this, making economy more active, right? A lot of people can actually start, and it's relatively easily, the business, and then, and then in 2016, the regulation CF, like a Title III of the Jobs Act, allowed small investors access to new crowdfunding portals. So this one actually allows people with relatively smaller income can actually invest too. So this regulation allowed investors with less than 107,000 income or asset can invest at least 2,200 per year, or a maximum like around 5,000. So when the people see good ideas, they can invest a small amount of money, even though they're not really rich individual, like who used to have access to those venture capital firms or their private equity, right? These ordinary people now have access to the pool of funds for the new startups through these crowdfunding portals. To sell securities through the regulation CF here, the company must file a form with the SEC, which makes the company eligible to list its securities on a crowdfunding portal that is approved by FINRA. The FINRA is the authority. This is a private, though it's regular. It oversees, actually, not regulate. It oversees the securities and transactions. And the SEC is the regulator, right? Even though SEC is not completely not the government body, but still, through this crowdfunding channel and through portals, and then selling the securities became much more accessible due to this regulation CF. And examples of the companies that started through the crowdfunding, became big. Now this Oculus that makes the virtual reality goggles, and Peloton makes gym cycles. Allbirds, I believe this is waterproof shoes. These are very popular, at least in New York. I see a lot of them. And, these all started through the crowdfunding. Now, let's talk about how you can sell securities, especially stocks, to the public. The public first. We're going to talk about private channel too. It's called a private placement. But if you want to sell your company's stocks to the public so that public can buy, which means raising capital for for your company. And Securities and Exchange Commission, in short SEC, the administers the Securities Act of 1933 and the Securities Exchange Act of 1934. These two are the very well-known acts in the equity markets, because those actually started all these processes. The basic procedure involved in issuing securities, and it's very similar for the debt securities too, but the company's management must obtain approval from the board of directors. So ultimately, board of directors decide, they're going to issue the equity to the public. The management to do all the due diligence, and then get the approval. And the company must prepare a registration statement. This registration statement is the document that disclose all the material information about the companies, and how they're going to actually making this offering, like how they're going to sell this securities, how many, and what price, but also about the companies. So there's a statement that needs to be filed with the SEC. So if the company filed this registration statement, then SEC examines the registration statement, and then there's a period called a waiting period. The company's waiting for the registration statements to be reviewed. During this time, the company can distribute copies of preliminary prospectus. So prospectus is another term, another document. Actually, it's a legal document describing the details of the issuing corporations and the proposed offering to potential investors. But this is a preliminary because the registration statement is not approved yet. But in this process, right, you can imagine, do you have experience? I keep assuming you as an audience are the owner of the startup business. Do you have the experience? Or even though your company is matured, do you have an expertise in this area? No, you don't. So many times you hire investment bank to help all this process. The firm cannot sell securities during the waiting period. That's why it's called a waiting period. The statement is not approved yet, but they can still talk to the potential investors, right? They cannot say, "Oh, this is approved, and then this is a price." No, but this process takes long. So companies go out with investment banks and then make an oral offers to the potential investors. Now the registration statement is approved. There is an effective date, and then the price of the security stock in this case is determined, and then fledged the selling efforts gets underway. We're going to talk about this one, what efforts can be made to actually sell the stock. Issuing method. So when a company decides to issue a new stock, it can sell it as a public or private, I said earlier. So public issue, as we saw in the process in the prior slide, the company is required to register the issue with the SEC. In the private placement, and it's called a placement and private issue. Stocks can be sold to a certain number of individuals, but there's a condition if these individuals are non-accredited investors. So there's a technical definition between accredited and non-accredited investors. But the non-accredited investors is only fewer than 35 that's recognized as private placement. Otherwise, you should go to public. And then for the private placement case, the registration statement is not required. So it's oftentimes called is unregistered offering. So you may, I encourage my students in the class, whatever class it is, to read the Wall Street Journal on a daily basis. You may have read or heard about initial public offerings and certain companies going public. You don't hear about all the private placement because it's sold to the certain number of private investors. So you don't hear about IPOs of every companies in the media. So when the company goes to public, there are two types of sales for the stock. So one type is called general cash offer. The name already implies, you sell securities and then someone buys and then you receive cash for that, right? And rights offer or a rights offering is another type of public issue of securities, but securities are offered to the existing shareholders. It's not just going to the public. It's you already have existing shareholders and they can purchase this extra securities offered. It's called the rights offering. I mentioned this term already, initial public offering, IPO. This is a very common term used, and you may have heard a lot. Is a company's first equity issue made available to the public. It's a different name is called unseasoned new issue. So now you can imagine, there is a seasoned new issue. Yes. So all IPOs are cash offers because it's his first time. And then seasoned equity offering, SEO, or sometimes a secondary equity offering, is a new equity issue of the securities by the company that has previously issued securities to the public. So after IPO, they can issue equity again. This time it's not going to be called IPO, it's going to be called SEO. Now, in this process of issuing, there are banks that are called underwriters. What are the underwriters? Underwriters, probably you already have underwriters, not in investment banks, but when you have any types of loans, credit card, whoever actually approves your credit line or amount, those are the underwriters. In generally banks, but whoever gives you credit are called underwriters. In the issuing the securities process, the underwriters are investment banks that act as an intermediaries between a selling company that sells securities and the public. So you don't hear much about the underwriters in the media, but if you read the articles carefully, when there's an IPO, those underwriters are actually mentioned. Oh, certain banks like a JP Morgan, Goldman Sachs, Bank of America, Morgan Stanley, those are actually the lead underwriters, or for a certain syndicate. Yeah, those type of things are mentioned briefly. So those underwriters perform services like formulating the method used to issue the securities. So this is what I said, like a quantitative aspect, and then pricing the new security and selling the new security. So what method of selling the securities is best? Are they potential private investors? Are they enough of them? Or if the company goes to public to sell, is there enough interest in the public? What would be the right price for the new stock? And how do you determine the price? And then how are you going to sell new securities in the market? Who are your potential buyers? Institutional buyers? So all those questions, right? It's hard to be answered by the company, just the company. It's usually underwriters have the expertise on that one. So the mechanism here is interesting. Typically, the underwriter buys the securities for less than the offering price, and they accept the risk of not being able to sell them. So I don't know, you knew this one already. So when the company does IPO, it's not the companies directly putting those stocks into the stock exchange, and then public can just buy. It's already sold to the investment bank before, and then or at the offering and at the agreed price, and then the investment bank put all those securities into the market. So when the investment bank, the underwriters, when they buy the securities, the stocks, the price is usually lower, and then the offering price, there's a difference between the buying price and the offering price. So that's the amount actually the underwriter receives, right? But on the other hand, that the company that issues the stock are paying to the underwriter. So it's called the gross spread. The spread is fee expense in the company's perspective, but it's a fee revenue for the investment bank's perspective. Another term called syndicate is a group of underwriters, group of investment banks that formed to share the risk and to help sell an issue. So what is the risk, and then why do they need help? Risk here, and apparently if the investment bank, let's say one bank buys all the shares, and then what if they cannot sell every share, and then there's not enough interest, or in that case, not all the shares can be sold, or the price can go down so much. There's risk for that one. If there are multiple investment banks as a group involved in this process and then purchase the stocks, they all make an effort to sell, and then the risk goes down. So it depends on, you gotta expect, market's reaction, public's reaction, and then what is the right price, because you cannot exactly forecast the people's reaction and the investors' reaction. And in syndicate, one or more managers, when I say manager, it's not just a person, it's a bank, arrange or co-manage the offering. Now, we're shifting perspectives quite often. So I emphasize this many times in corporate finance case. What perspective are you in? Are you in a corporation that uses investment bank, or even inside a corporation? Are you the CEO or a CFO, or you are just finance professional who does analysis, or are you the shareholder of the company, or are you an investment banking analyst or investment from companies analyst who analyze these companies from what perspective? Are you buying the shares of the company, or you are selling these shares on behalf of the company? All those are different. And yeah, there is a term called the buy side, sell side in this industry, in the banking industry. But in corporate finance case, oftentimes we talk about the perspective of the company's CFO. But many times it overlaps with the investment professionals or banking analyst perspective. So this time, choosing an underwriter, of course, this is your company, you're hiring investment bank. So that's your perspective. So firms can offer securities to the highest bidding underwriter on a competitive offer basis, or negotiate directly with an underwriter on a negotiated offer basis. So imagine you wanna issue securities to the public, but you hire an investment bank, and then they want a fee, but also they bid multiple banks, right? Multiple investment bank bid, and then you can actually see their fee basis. They say when they provided this type of service to you, right? This is the fee they charge, right? That you can actually compare, right? And then choose one bank or several banks. Or negotiated offer basis. You talk to, if you have your investment bank, or if you just chose one, you just negotiate with them. You know what? I want to hire you, but we wanted this fee, certain fees lower. Something like that. So negotiated offer basis is more common approach, though there is evidence that competitive underwriting is cheaper to use. So yeah, this is just it really depends. But when does this competitive offer basis bidding is used? It's commonly in public utilities holding companies. It's by law, they're required to do competitive underwriting. They cannot just choose one bank because there's, let's say, you're an electricity company that provided electricity to the certain state, right? They cannot favor a certain investment bank. The government requires them to go over, all the bidders, and then to review multiple banks' bids and then decide. Three basic types of underwriting are involved in a cash offer. So remember, it's like IPO case, cash offer, and you are hiring an investment bank. Just imagine like one investment bank is hired to do this job, and then there are different contract, firm commitment, best efforts, and Dutch auction. So what is a firm commitment underwriting? The underwriter, the bank, or the syndicate of banks, buy the entire issue, assuming the full financial responsibility for any unsold shares. As I said earlier, right? The investment bank already buy everything. So as in the perspective of issuer, your company, you already sold everything to the investment bank. So it's fine. In terms of selling all the shares, you don't have a risk, but even though you're not sure that was the right price or not, but in firm commitment underwriting, the investment bank that bought all of the shares now have to sell everything on the market. So, and then they're gonna have to sell in the right price. That's what it's a financial responsibility means. How are they gonna sell everything? And then how are they gonna make a profit? If they can sell higher price, right? And everything, they make a lot of profit. If they don't sell everything, and or the price is sold in too low, they're gonna make a loss. This type of the underwriting is actually most prevalent case in the US underwriting market, in IPO market. But the offering price here is the, in IPO case, the first that needs to be specified before going to the market. It's usually not set until the underwriters have investigated how receptive the market is to that issue. So how does the investment bank, or how do investment banks that investigate in this case, how do they check how receptive the market is? So that's the job, investment bankers do. How do they know how market will react? So they cannot tell exactly entire public will buy, or there will be really a lot of demands on certain stocks, right? They talk potential investors. The investors are specialized in the certain industries, but they already have set of investors, private or institutional companies. I mean institutional investors, or the other funds, insurance companies. That's why investment bankers actually travel a lot, meet people, clients, and potential investors. They need a huge network of people, and then talk to them and see their people's reactions, companies' reactions, how they are willing to buy. Also, they are willing to express their interest because they want to be involved in this purchasing, in the stocks, right? In IPO case, you investors don't want to miss out the opportunities of generating a lot of returns, right? When you purchase an IPO price and then it just pops and then the price goes really high. But if you didn't buy those stocks, you missed opportunities. But its risk is involved in there. Risk of being unable to sell all the issue at the agreed upon offering price. But it's usually minimal. That's what, investment banks make sure, they sell all the issues. But we'll talk about this different mechanism a little bit. And also to determine the offering price, offering price needs to be specified and then it's registered with the SEC. But in order to determine the offering price, until the day of the IPO, the underwriter will meet with potential buyers and large institutional buyers. They discuss, right, and what is the right price, because this is not like this set the price and then put it in the market and see what happens. No, it's not like that. Underwriter and the company management together will do the presentations, and they go to the many different parts of the countries of the world, bring the pitch books. Pitch book has the explanation about the company and the management, what the business is doing, and then what's their forecast, economic environment in the industry, industry landscape. All these information is presented to the potential investors. It's called a roadshow. So that's why the investment bankers are on the road many times. presenting these opportunities to the potential buyers. The process of soliciting information about the buyers and prices, the quantities the buyers would actually demand, right? It's called book building. So let's say, I'm an investment banker, you are the company founder, your company is going to public, but you and I travel together to meet and then potential buyer, which is like a large institutional buyer, let's say, so a mutual fund manager. Then we presented the opportunity, and then probably we're gonna sell 1 million stocks. Or they said, oh, I want 100,000 stocks, and then at this price, we talk about it. So I mark 100,000, buyer here, and I need to find other buyers to sell remaining stocks, something like that. That's called the book building. Second type is called the best efforts underwriting, which is less common than the firm commitment underwriting. This is interesting. This best efforts underwriting, the underwriter, the bank, investment bank, sells as much as they can do. It's like what is as much as they can do, but they can return any unsold shares to the issuer without any responsibility. But there's a caveat. So in this case, underwriters did not agree to purchase all of the securities from the issuer, unlike the firm commitment. But underwriter is legally bound to use best efforts. If the company that hires the underwriter believes they did not use the best efforts to sell, they can sue. Underwriters does not guarantee, though, any particular amount of money to the issuer. Like, oh, we're gonna definitely sell this like 1,000 shares at this price, and then no, they don't do that. But there are certain conditions, all or nothing, or part of none, something like that. So if the underwriter, the investment bank, does not sell all the security until a certain time, they're gonna have to just return everything to the issuer. Or if there's some part or none, there's agreed amount in a certain timeline. If they don't do, they'll return everything. Certain conditions are there in the best efforts, but this is less common. Now, third one, okay, this slide involves a little bit of numbers here. So Dutch auction underwriting. What is the Dutch auction underwriting? Again, remember, there are the potential bidders for underwriting. Yeah, so the offer price is set based on the competitive bidding by investors, so also called the uniform price auction. So example in the table, the company wants to sell 400 shares to the public, and then if they receive the bidding, let's say bidder A can say, oh, we can buy 100 shares at price 16. Or B company says, oh, B 100 shares, but lower price, 14. And all these 5 companies, like C, D, E, and then E bank says 200 shares, but we can buy at lower price. So you can buy more shares, but price needs to be lower. So price is not set. How can an issuing company sell to these bidders? Who's the winning bidder? And then everything goes to winner. They have only 400 shares, right? No one is willing to buy 400 shares at the highest price. That would be easy. So in Dutch auction case, the company examines the bids and then look at the highest price possible. So this is already sorted from the highest price to the lowest price bids. And then check and what price they can sell all the 400 shares. So 100 shares at 16, 100 shares at 14. Oh, I'm sorry. I'm so confused. I'm confusing you. Actually, so yeah, I mean, this is right. It's from the top. You got to read this quantity wise. You got to read the 400. Where here 100, 200. Okay. So this is 400 shares. Can they sell like that? A and B can buy up to 200 shares. The price is too high. So the 400 shares won't be sold until the hit is $12. So here's the thing. So you are actually there are two bidders with the same price. So that's a problem. So in order to sell the 400 shares here, you see the two same prices. So you cannot sell to the C, ignoring D, because they offer the same price according to the Dutch auction. So what happens? You got to sell some amount to the D as well. And you cannot sell like A to only B, like a C and D. You got to spread these shares through all to A to D. And the price will be the $12. You cannot sell like to the different people with a different price according to the Dutch auction. So that's what I'm trying to show here, right? So, but how to determine whom to sell and what price, you got to take a look at this amount and price from the highest price and then going down to the lowest. So the 12 will be the offer price. And then E bidder will not get anything, only to D. So in underwriting, the aftermarket is the term called for the period after a new issue is initially sold to the public. So after sold initially, and then now it becomes the aftermarket. So during this period, it's the members of the underwriting syndicate. So assume syndicate is very common. There are multiple banks are underwriters. And generally do not sell security for less than the offering price. So they have all the shares, right? If they have the shares, they don't go below. Remember how the price is determined in the market. Someone gotta sell it and someone's gotta buy it at price. And then they don't below the offering price, they don't sell it. If the market price falls below the offering price, let's say, the principal underwriter is permitted to buy shares. So what happens? Why? The price is going to the below offering price, which is not great for investment banks and the issuer. Principal underwriter will steps in and want to buy it. What happens in the market? If someone buys this product, more and more people want to buy it as a product. In this case is stocks. Price starts going up. So that's how you can stabilize the price. Many underwriting contract contain green shoe provision. The green shoe provision is the option, actually, the provision gives the option to the members of underwriting groups in the syndicate to purchase additional shares from the issuer at the offering price. Let's say you don't know this price. I mean, a certain price, a certain stock can be really, can have a lot of demands. In case there are excess demand, and then or the oversubscription, there you already promised and too many people to sell. And with the discrete issue provision, those banks in the syndicate actually purchase additional shares if they did not actually purchase everything at an offering price instead of a higher price on the market. And the lockup agreement is also another term. Specify how long insiders must wait until IPO before they can sell stock. So IPO happens, and then insiders like this C-level management, they have information about the company and what they're doing and how they're doing. They cannot just sell immediately after IPO. It's a lockup agreement actually prevent that. It's not required by law, but it's found almost on underwriting contract. In this case, in investment banks as well as in insiders, it's becoming standardized. Like usually 6 months, you can't really sell, and otherwise it can destabilize the market. People with insider information actually trade right after the IPO. So in this process of public offering, and once the firm files a registration statement with the SEC requires that the firm and its managing underwriters observe a quiet period. Another term, quiet period. So today we're covering a lot of different terms. During this time, all communications with the public must be limited to ordinary announcements and other purely factual matters. Well, this is all defined by SEC. Releasing new information would be against the rules of the quiet period, so any information shared during that time could be seen as insider information. I mean, just one example, Elon Musk was tweeting a lot of things about the company. SEC was involved in that, that kind of case. When there isn't a quiet period in initial public offering, if you or investment bank make offers to the other investors providing different informations which is not known public, it's called jumping the gun or gun jumping. You're trying to, you actually gun jumping, meaning you pulled out your gun too early, so you're not supposed to do that. So quiet period, you are not supposed to communicate inside the information or major changes to the company other than you registered. You disclosed it to the SEC in a registration statement. This period ends 40 days after the IPO happens. This, other than using the investment bank and then underwriter going through all these processes, and there's another way of listing your stocks to the market and to the exchanges, right, for the market. It's called a direct listing. The firm, a company, arranges for its stock to be listed on an exchange without marketing and other help from an underwriter. It happens, and it happened in the past. As Spotify did that, and then there are other companies. Time to time, you read on the paper, this company just did the direct listing to oftentimes NASDAQ, tech companies. So in this slide, I included a link to the case This is Harvard Law School case about the Spotify, how they did a direct listing. So just when you have time, read about this one, what it is, why do they do that. It's pretty good information here. Actually, I did not share. Actually, where is this? Yeah, Safari. Yeah, the Harvard Law School forum, this Spotify case study. It's a good read. Okay. In IPO, we oftentimes stock price goes up, I mean, really high, usually on the first day, the higher than the opening price. So it started with the offering price, but let's say a lot of people are trying to buy the stock. Why? Because they think the price will actually go up. So that drives the price really high. That's called the first day pop. But this pop is a pop because it doesn't last like that. It actually goes down oftentimes. Historically, the first day pop on IPO is around 14%. And then, but if we feel like it's a lot more because we hear about that when I remember when the Facebook stock went public, the price went so high first, but it came down. So people remember this like a lot of media coverage, right? And then media tends to cover a lot of like big pops, but actual percentage is only 14. The following chart in the bit below, it shows the average first day return and then aggregate money left on the table. Why? So my point here is, okay, there's a pop, but what money is left on the table? If the price goes up, right? If the price determined by the public and then whoever want to buy and sell, if going is higher than the offering price. Just example, you are offering a stock at $50, but as soon as you went to public, it became $100. What happened? You sold all your stock at $50, but your actually company's value is double. So market is actually buying that one, but you lost that amount of money, the difference in initially selling your stock. This is not about your company's valuation. Your company's value will go up, market capital wise, but you did not make money in the initial public offering for the sake of raising capital. So that's what you left money on the table. There is a cost of selling stocks to the public. It's called overall. It's called the flotation cost. I explained the one first, and then earlier, gross spread. Right, spread is consists of direct fees paid by issuer to the syndicate. That's a price difference. And there are other direct expenses like their filing fee, and you're also legal fee. The lawyers need to be involved in this process, and the taxes. Indirect expenses are a little subtle, not reported in the prospectus, but it includes the cost of management time spent on these issuances or the lost money. Abnormal return is also indirect cost. In a seasoned issue of stock, the price of existing stocks drops when there is an announcement of an issue. That's also implicit actually cost. Underpricing related to the first day pop. The underpricing is a topic of discussion. Are the underwriters tends to price lower than it should be? The underpricing exists. If the price is set low, even though that made stocks to be sold completely, but you're leaving the money on the table. So underpricing can be actually cost too. And greenshoe option also in the perspective of the issuer, if this option exists, underwriters have the right to buy additional share in the lower than the market price. So though these are the actual cost. Direct cost can be really large. We'll see in the next slide with the case study. Sometimes it goes to 25% of the capital you are raising. Typical underwriter spread is like 5 to 10%, and that's mostly 7. This is a high fee, and that's why investment banking is lucrative in terms of fee. I mentioned about underpricing, but the cost associated with the selling debts are substantially less than the selling equity. So in this, I mean, it's just a comparison. We can talk about this one in the more like debt markets. Let's just see an actual case of the flotation cost. In 2020, Black Diamond Therapeutics, the oncology medicine company, went to public through IPO. So they issued about 10 million shares of stock, a price of $19 each, the offering price. The lead underwriters on the IPO were JP Morgan, Jefferies, Cohen, and assisted by a syndicate of other investment banks. See, there are multiple investment banks, whether large bracket or the boutique firms that are involved in this one. So IPO raised a sum of $201 million, right, by selling those stocks. But actually, the Black Diamond Company got only $184 million after expenses. So expenses is almost a $16 million. That's a lot of money to just issue securities. Well, for certain banks, well, not a lot, but imagine you were raising 200, but you're paying 16 million. There's a fee, right? The big portion. The biggest expense was 7% underwriter spread, right? Because you had to sell lower to the underwriter, which is usual, right? It's the spread, changes depending on the multiple factors, but the size of the offering is also one factor. But that's not uncommon if you use an investment bank. And Black Diamond sold each of the 10.59 million shares to the underwriters for $17.67. See, this is lower than the offering price. And then they had to sell this one to the underwriters. And then underwriters sold this one at $19. Yeah, when IPO happens. And also, Black Diamond spent $24,000 in SEC registration fees and $28,000 in FINRA filing fees and $125,000 in exchange listing fees and $1.3 million in legal fees. Now you understand why the lawyers in corporate law, and they make a lot of money. $950,000 in accounting to obtain two unnecessary audits. Yes, auditors, accountants. $4,000 for transfer agent to physically transfer the shares and maintain a list of shareholders. $150,000 for printing and engraving expenses. Yes, there are a lot of expenses. $10,000 for blue sky fee, and finally $98,000 in miscellaneous expenses. There's so many expenses, right? If people work longer hours, and then also. So IPO can be really costly. And even though they raise a lot of money, the cost is pretty high. Yeah, it's inevitable. And the total direct cost was almost 9% of the issue proceeds. The stock actually the more than doubled on the first day of trading. So indirect cost in this case is much larger. Indirect cost is that those money left on the table, if you call this one underpricing. Now, switching gear from the initial public offering, let's talk about a rights offering. Less well known, you maybe don't hear about this in the media as often as the IPO, but stocks are issued to the existing stockholders. So if you own a stock, sometimes you get the option, you get the right to buy more stocks when there are new issues. That you have the right. That's why it's called a rights offering. They have like the companies actually give you rights to the stock. I mean, you as a stockholder. It's called privileged subscription. So you have a privilege to buy new stocks before the public can have access to it. Each shareholder is issued rights to buy a specified number of new shares. It's not just a one always. If you have one stock, you can buy only one more stock. No, it all depends. At a specified price within a specified time, after which the rights are set to expire. So it works a little similar to the options. You have a right to exercise this your right. You can choose to buy it or just let it expire. Don't buy it. But you may be able to buy multiple shares, new shares at a certain price, which could be lower than the future market price. If you don't like it, just let it expire. The terms of the rights offerings are evidenced by the certificates known as share warrants or rights. Maybe you heard this term more, warrants in terms of share, more than rights. These rights itself are traded on a securities exchange as well or over the counter. Someone can actually just sell your rights to someone else. The other reason you don't hear much about the rights offering is in the US, it's not really common. And it's more common in the other countries than cash offer. It's cash offer is a much common in the US and then IPO market. That's why it's much more popular. The rights offerings tend to be cheaper than the cash offers for issuing firms because you don't need an underwriter is required in the rights offering. You can just issue, let's say, you already have the set of the stockholders. You can just sell those, new issues to the new existing shareholders, see what happens. So IPO case, underwrite is almost necessary unless it's a direct listing. Even in direct listing, sometimes you have advices from the investment banks, even though they don't underwrite. The value of a right, it's a little bit of math here. Let's see. Suppose a shareholder of National Power Company, example company, owns 2 shares of stock just before the rights offering is about to expire. Initially, the price of National Power is $20 per share. And then, so the shareholder's total holding is $40. And then rights offer gives a shareholder with 2 rights to purchase on 1 additional share for $10. The additional share does not carry a right? So the new share does not have the rights. Otherwise, it's keep going. So stockholder who has 2 shares will receive 2 rights. Holding of shareholder who exercises rights and buys the new share will increase to the 3 shares, let's say. So you have $40, now you buy one more, and then $50, but now you have 3 shares. So what happens to the value? The value becomes $16.67 per share, right? It became like that. So rights offerings are usually arranged using standby underwriting. So standby underwriting is where the underwriter agrees to purchase the unsubscribed portion of the issue. Think about it. As a stockholder, you just may pass. I don't want to buy additional shares. I don't have money, or I'm not interested in. So shares may not be sold fully. And then there's an underwriter that stand by to purchase that portion, unsold portion. The underwriter usually gets a standard fee because you have a contract to be a standby underwriter, and then you receive the fee for that. And then when you purchase an additional amount based on the securities you buy, and then this one protects the issuing company against the undersubscription because you have a buffer, and your underwriter will purchase. Only a small percentage of shareholders fail to exercise value rights. Many people tend to exercise rights, and shareholders are usually given an oversubscription privilege, which allows them to purchase unsubscribed shares in a rights offering at a subscription price. So outside your right, if there are still unsold shares, you can still purchase them and at subscription price. So this is an option, that's privilege. The last topic for today is just you may have heard this word, dilution. In case of stock, dilution is the loss in existing shareholders' value in terms of ownership, market value, book value, and earnings per share. Dilution of proportionate ownership can arise whenever a firm sells shares to the general public. But the dilution of ownership of existing shareholders can be avoided by using a rights offering. What does it mean? If your company have 100 shares, right, you have 100 shares, but you have a right to buy additional share. So the company issues 100 more shares. If you buy them, you own 200 shares total. So you have the same ownership as before. If you don't buy them and someone else buys that 100 share, now you own only 50% of the company only. So if you exercise your rights offering, you can avoid the dilution. Otherwise, your ownership will be diluted. The dilution can happen through the book value or market value. Market to book ratio is the market value to the book value ratio is less than 1. The market value is lower. Increasing the number of shares does not cause the earnings per share goes down. This is accounting wise, this is actually just accounting dilution, but the market value does not get diluted. Market value is diluted only if when a company takes a project of net present value is negative, which causes market price to drop. So this dilution concept is conceptually, you gotta just think about it. When this dilution actually happens, what's the impact to you as an investor? There are more things to think about, and then accounting wise, and then there are some things you can actually calculate, but we're not going that detail in this seminar. Today's topic was about the primary equity market, overall mechanism and foundations and terms and players. So for next week, different instructor will continue the secondary equity market and the debt markets for the seminar. And then this is my last time for this seminar. And hopefully I can meet you or see you in the future seminars. Thank you all for joining today, and I encourage you to keep joining the rest of the seminar for the semester. Thank you all.